Hello, everyone. In the current stage of accelerated penetration of the digital economy, digital currency has gradually integrated into the field of financial investment, becoming an indispensable component of the market. Today, we will study Section 6.4, Application Cases of Digital Currency in Financial Investment, from the series course. Development of digital currencies. In the financial market, we often encounter scenarios such as investment trading of digital currencies, cross-border payment and settlement, and asset portfolio allocation. For example, some investors conduct coin-to-coin trading through digital currency exchanges, and some cross-border enterprises use stable coins to complete payments. These practical operations all involve the specific application of digital currency in financial investment. So, what is the operating logic behind these application cases? What risks and advantages exist? In this lesson, we will analyze typical cases. We will study 4 aspects of digital currency in financial investment. 1. Trading application cases. 2. Payment application cases. 3. Investment portfolio allocation cases. 4. Risk management application cases. Through this lesson, I hope you will be able to understand the main scenarios of digital currency applications in financial investment. 2. Master the operating logic and characteristics of typical cases. 3. Analyze the risk-return comparison of different application models. Trading applications are the most common scenario. In digital currency, financial investment, mainly referring to the exchange of digital currency for fiat currency, or digital currency for digital currency through exchanges. Here, digital currency includes mainstream coins such as Bitcoin and Ethereum, which have high market recognition and wide acceptance in the market. In addition to mainstream coins, there are also stable coins such as USDT, whose prices are relatively stable and are often used for trading and settlement. Take coin-to-coin trading as an example. An investor exchanges 1 Bitcoin for 5,000 Ethereum on an exchange. If the price of Ethereum rises later, the investor can sell the Ethereum to exchange for more Bitcoin, thereby making a profit. The core of this type of trading is to take advantage of price fluctuations between different coins, buying low and selling high to capture the spread. Currently, major exchanges such as Binance and Coinbase offer such trading services and support functions such as real-time market viewing and order placement. Payment applications focus on the use of digital currency in the settlement stage, providing new settlement methods for transactions. They are particularly prominent in cross-border payments. Traditional cross-border payments must go through interbank clearing systems with complicated procedures and long processing times, usually 1-3 working days, whereas digital currency payments can rely on blockchain technology to achieve point-to-point settlement, greatly shortening the time. Take cross-border e-commerce payments. As an example, a Chinese export enterprise sells goods to a European customer, and the two parties agree to settle in USDT. The customer purchases USDT at a local exchange and transfers it directly to the enterprise via a wallet address. After receiving it, the enterprise can exchange it for renminbi at an exchange. The entire process usually takes less than 10 minutes, and the fee is far lower than that of traditional bank remittances, about 1/5 of the traditional cost. Stablecoins, due to their small price fluctuations, have become the main choice for such applications. Including digital currency in traditional investment portfolios has been an area of exploration for institutional investors in recent years. Traditional investment portfolios often include stocks, bonds, and commodities, while digital currency has a low correlation with these assets and can help diversify risk. For example, an investment portfolio, originally composed of 60% stocks, 30% bonds, and 10% cash, had a maximum drawdown of 15% and a Sharpe ratio of 0.8. After adding 5% Bitcoin, backtesting data showed that the portfolio's maximum drawdown decreased from 15% to 12%, and the Sharpe ratio increased from 0.8 to 1. This is because Bitcoin's price fluctuation logic differs from that of traditional assets. When stocks fall, Bitcoin may remain stable or even rise due to market risk aversion sentiment or independent market trends. It is important to note, however, that digital currencies are highly volatile, and allocating an excessively large proportion of them in an investment portfolio may increase the portfolio's overall risk. Price fluctuations in digital currencies can be extreme, with single-day swings of over 10% being fairly common, creating significant uncertainty for investors and making effective risk management essential. Common risk management tools include futures, hedging, and options insurance, with the core being to lock in prices through derivatives to reduce uncertainty. Take miner hedging as an example. A Bitcoin miner can mine 10 Bitcoins per month with the current price at $30,000 per coin to avoid a reduction in income caused by a future price drop. The miner sells 10 Bitcoin futures contracts maturing in 1 month on the futures market at an agreed price of $30,000 per coin. If the price of Bitcoin falls to $25,000 after 1 month, selling in the spot market would yield only $250,000, but the futures market would generate a profit of $50,000, keeping the total income at $300,000 and achieving risk hedging. In this lesson, through cases in trading, payment, investment portfolio allocation, and risk management. We have analyzed the specific applications of digital currency in financial investment. These cases show that, with its technological characteristics, digital currency has expanded the boundaries of financial investment. In trading applications, it can profit from buying low and selling high on price fluctuations. In payment applications, it enables fast cross-border settlement with low fees. In portfolio allocation, it can diversify risk through low correlation with traditional assets. And in risk management, it can lock in prices through derivatives, learning the investment characteristics of digital currency and enriching the range of investment options is the trend in our financial investment and wealth management. Everyone, that concludes today's lesson. Please complete the following exercises, and I will see you in the next class.